Compute a predetermined overhead rate and explain why estimated overhead costs rather than actual overhead costs are used to compute our predetermined overhead rate and allocate overhead to jobs. Accurately allocating manufacturing overhead is important for two reasons. First, we need to determine the profitability of existing jobs. The second, and perhaps more important reason is to accurately cost or price potential future jobs. In bidding on jobs, it's important that we accurately quantify direct materials, direct labor. In addition, it's equally important to estimate overhead costs associated with the job. If we're unable to accurately estimate and allocate overhead costs, we are likely to suffer from a winner's curse. That is, most of our winning bids will be on unprofitable jobs. This is because underestimating our overhead costs will likely result in lower bids, which in turn means we're likely to win more bids for jobs that ultimately turn out to be money-losing jobs. On the other hand, consistently overestimating overhead costs will result in higher bids, and higher bids will translate into fewer winning bids, that is, we'll miss out on the more profitable jobs. If we weren't concerned with product pricing and bidding on new jobs, or in preparing interim financial reports, we could allocate overhead based on actual costs. That is, at year end, we could calculate an actual overhead rate based on actual total manufacturing overhead costs and actual activity levels. Nonetheless, due to the nature of indirect costs, this still would not be ensuring completely accurate or true job costing. By the very nature of indirect costs, all we can do is allocate them or assign them to jobs. Recall, direct materials are costs that we can trace directly to the job, as well as direct labor costs. Our manufacturing overhead, by definition, is difficult, if not impossible, to accurately trace to jobs. Since we are interested in setting prices, that is, bidding on new jobs and preparing interim financial statements, we must allocate overhead on the basis of a predetermined overhead rate. That is, our predetermined overhead rate is based on an estimated total manufacturing overhead cost for a period and an estimated activity level. And again, ideally our activity level or cost driver will be our allocation base that is causing or driving our actual overhead. Manufacturing overhead then is applied to jobs using the estimated predetermined overhead rate multiplied by an actual activity level, or when setting prices or bidding on jobs, we'll use our predetermined overhead rate multiplied by some expected level of activity associated with that job. For example, assume that we apply overhead to jobs on the basis of direct labor hours, and our estimated total overhead for the year is $640,000, and we estimate that we're going to work 160,000 direct labor hours. Then our predetermined overhead rate would be $4 per direct labor hour. Let's consider another example. Given the following information about manufacturing overhead, direct labor hours, and actual manufacturing overhead and direct labor hours, let's calculate our predetermined overhead rate. Recall, our predetermined overhead rate is our estimated manufacturing overhead for the period, which in this case is our $34,000, divided by our estimated direct labor hours of 13,600. So we'll have a predetermined overhead rate of $2.50 per direct labor hour.